All right, again, I apologize for not being able to meet with you in class yesterday, but unfortunately, there was a little bit of a medical emergency I had to deal with in the family, but fortunately, everything is just fine with that. After I finished explaining these answers, I will post this entire document to Moodle so that you have access not only to the formal answers here, but also the outline and discussion question answers as well. So let's just start here with number 2. Remember that the answers here presume that you've already made one adjusting entry, and that is to eliminate the impact of sales and cost of goods sold. So before even this entry would be made, you would debit sales and credit cost of goods sold for the $250,000. Now, in a sense, immediately after that, what you would have to do is to recognize that of that amount, 40% hasn't been sold. So that 100,000 can stay there, but it has to be reduced back to its cost. And so the 40% of that, that is the 40% of 250,000, 100,000, that's the amount that's left. Okay, and the gross profit percentage is 30%. So those are the two major ones. First, that 40% of the total sales are left in inventory. So the 100,000 in a sense needs to be reduced back to its cost. And the way you do that is taking it times the gross profit percentage of 30%. So the 30,000 would be the amount of the adjustment that would have to be made. All right, number 3 is pretty straightforward. And what you're looking at here is the non-controlling interest and minority interest. And what portion do you need to adjust because what has to be recognized for them? Well, for downstream sales, nothing at all will be adjusted because downstream sales impact only the equity of the parent. It's only when you have upstream sales or any transaction moving from the subsidiary to the parent that you have to recognize the impact of that on the non-controlling interest. So as the answer A says, that the subsidiary's reported net income is adjusted for the impact of upstream transfers prior to computing the non-controlled interest account. Nothing is made for any sale that occurs between the parent and the subsidiary for non-controlling interest. Okay, the solution to number 4 is a little different than perhaps what has been shown in some of the other sections, but it's a little bit easier to look at. And that is, in each of these years, in 2014 and 2015, they identify the amount of gross profit that was generated by the downstream sales. In the case of 14, the difference between 200,000 and 160,000. And then in 15, the difference between 350,000 and 297,500. So the total gross profit, for example, in 2014 is 40,000. Well, okay, if we assume that sales or remaining inventory is going to be proportional, then if that gross profit would again be proportional, the amount left would be proportional to the amount sold, that what's left is the 18% is the amount of gross profit in the ending inventory. And then likewise, if assuming that the percentage changes to 30%, well, if the total gross profit was 52,500, then if the inventory remaining is 30%, then the amount of the adjustment is going to be 15,750. Again, the assumption with these is that gross profit is assumed to be earned proportional with sales. So if you sell 80% of your goods, then 80% of the gross profit would be earned. The other 20% would not be earned. And it's always the amount that's not earned that is of interest here, because the amount that's not earned is the amount of the adjustment that's going to have to be made. The assumption in both of these years is that sales and cost of goods sold would have been adjusted, that is to eliminate the impact of sales and cost of goods sold. Then, as a secondary matter, you go in each year and adjust the inventory down. Debit cost of goods sold, credit inventory for 7,200 in 1 year, 15,750 in the second year. All right, the second part of the question is, in 2015, what is the amount of cost of goods sold? Well, we start number one with the amount of the sum of the two, that is, the parent and the subsidiaries. Now, the other thing that I always tend to forget, which is a very simple one, I have to adjust for the amount of intercompany sales. Remember, I said you debit sales and you credit cost of goods sold to remove the impact of intercompany sales. So, three very simple things you're always going to do. Number one, add cost of goods sold to parent plus the cost of goods sold of the subsidiary, subtract out the amount of intercompany sales. Now, the second part of the adjustment are these two items here. And the idea behind this is that in 2015, you go back and say, in 2014, we deferred and we essentially increased cost of goods sold for the 7,200 because it was assumed not to be earned. And so this means, because I would have adjusted inventory downwards, and then I would also have to, upwards, and I have to, I'm sorry, in 2014, I would have credited inventory and debited cost of goods sold for the amount of the gross profit that was not considered to be earned. However, in the next year, the 7,200 is considered to be earned because, again, kind of a FIFO basis that the assumption is that inventory is going to roll over. So that's going to be, these are the sums of my cost of goods sold. So that's going to be subtracted. I already subtracted out in the previous year. I'm going to add it back because my assumption is now that those items are going to be sold. And then likewise, the 15,750, that would be considered a debit to cost of goods sold, a credit to inventory, because that goes in here as a plus number. And one of the mistakes I tend to make is I get my signs mixed up with these. These are the sum of the two cost of goods sold less the adjustment for the transfer. Add back, in a sense, reduce it for the amount of sales that took place in 2015 that you deferred, the recognition of that. And then likewise, because you're adjusting inventory, you're going to have to adjust cost of goods sold for the 15,750. All right, number 5 is kind of a common CPA exam question where they're essentially increasing a little bit of complexity by giving you two numbers involved here. First of all, that the amount of sales that would be recognized in consolidation would be the sum of the 800,000 for the parent, the 300,000 of the subsidiary. However, you must subtract out the $100,000 of intercompany sales. So 800 plus 300 minus 100 would give you the $1 million in sales, which then leads you to, okay, now I only have to worry about answers A and B here. Okay. Likewise with the cost of goods sold adjustment. Number 1, if you take the amount of cost of goods sold for the parent and subsidiary, it's a sum of, make sure I'm reading these right here, the 600,000 plus 180,000 gives you 780,000. But I must subtract out the $100,000 of cost of goods sold from that because of intercompany sales, which takes me back to $680,000. There's one more adjustment, and that is there's $40,000 of inventory still sitting on the books that has not been sold to outsiders. And because the gross profit rate is 25% here, that is 25% of that gives me 10,000. I'm going to credit my inventory, debit my cost of goods sold for 10. So I'm going to move from 680 back up to 690, which gives me the answer of A. Again, be careful with the pluses and minuses when you're playing around with cost of goods sold. The 600 plus 180 gives you 780 minus the adjustment for the intercompany sales takes you down to 680. But the adjustment for the intercompany profit or gross profit in ending inventory is an adjustment of 10,000, which is going to be added to my total cost of goods sold, bringing it back up to 690. All right, number 6 is basically the same information. So we come back to the issue that the total intercompany sales would be, at least for consolidation, would be 1 million. Taking the sum of the two, however, you have to subtract out the $100,000 of intercompany sales, which takes you to 1 million. Likewise, too, if I take the total of the since we're talking in terms of the subsidiary's cost of goods sold is going to be, if I'm looking at it in terms of upstream sales, again, going back to the total amount of cost of goods sold, 600 plus 180, less 100,000, 680. But the thing that's different here is I still have the 40%, okay, of $40,000 of inventory still sitting on the books. But the gross profit rate of the subsidiary and its sales is 40%. And that is just taking 120,000 over 300,000. So 40% of that amount is 16,000. It's going to be added to get to the $696,000 worth of cost of goods sold. All right. Well, number 7 is looking at essentially what is the net income of the subsidiary. Well, first and foremost, let's look at what we're going to start with. Number 1, reading through all the information I gave you, the subsidiary earned $90,000, or it has $90,000 of net income. Now, to get at what happened in 2015, 2 things happen. One is that I have to go back to what I did in 2014, where I deferred a certain amount of gross profit, where I would have debited cost of goods sold and credited inventory. Well, that is, they tell you that in 2014, there was $40,000 of inventory that was not sold. And the gross profit percentage, which you calculate just the difference between the sales and the cost of goods sold, and take that over the sales figure, gives you 30%. Well, $12,000 was deferred. But that $12,000 is assumed to be earned in the following year. Again, kind of assuming a FIFO basis. So in essence, what's deferred in one year is added to the next year in terms of net income. So starting with the $90,000, I would then add back the $12,000. However, the $20,000 is assumed to be deferred. And in fact, I'm going to add to my cost of goods sold. What they tell you is that $50,000 of inventory was not sold, and the gross profit rate, at least in 2015, is the 40%. And so 20,000 of it would be deferred. Debit cost of goods sold, credit inventory. So the net amount of the amount of net income of the subsidiary after these 2 adjustments is 82,000. Now, since non-controlling interest is 10%, 10% of the amount of $8,200 is the amount attributable to them. All right, with number 8, before we look at the specifics, there are essentially 2 things that you need to always keep in mind when you look at the sale of any asset, long-term asset, between a parent and a subsidiary. One is that I need to, 1, remove the gain, whatever that is there. And that gain is going to be removed in the year of sale by just eliminating the gain, and then in subsequent years by adjusting retained earnings. The other adjustment that you need to make here is because the asset was sold at more than its book value, then the consolidated entity is going to be depreciating it over a greater cost figure. So that excess depreciation between what the subsidiary is depreciating it at versus what the parent would have depreciated at needs to be eliminated. In other words, because the asset was sold, that it will stay, in essence, on the consolidated book end at its book value. And so that's going to be, and to a certain extent, that book value, what the original depreciation expense would be, is the only amount that you'll recognize throughout the life of this asset. Okay, so we'll start with the first element here. That is, the machinery was sold at $40,000, even though the book value here, write this in here, is equal to $30,000. So the parent at the time of consolidation, or the consolidated entity, is going to debit the gain and credit the asset for $40,000 or for $10,000. All right, I have to go back and reread this one. All right, this item that they have is a book value of $30,000. They sold it for $40,000, which generates a gain here, as we said, of $10,000. And so in the first year, the gain has to be eliminated. Now, the result of the sale was to increase, in a sense, the carrying value from $30,000 to $40,000. So that means that the subsidiary is going to, in a sense, be depreciating that additional $10,000. Now, the original $30,000 is not a problem. The problem is the additional $10,000 that you've added to the carrying value of this asset by making this an intercompany sale. And that $10,000 over 5 years is $2,000. That's the amount of additional depreciation expense. So the amount of the adjustment in the first year would be the $8,000. All right, their explanation does not look real good. So let's look at 2014. Well, in 2014, what ends up happening is that you have to subtract out the gain of $10,000 because they're selling something that has a book value of $30,000 for $40,000 between related entities, so that has to be eliminated. The transfer of the asset is fine, that's not an issue, but you can't inflate the value of the asset by making an intercompany sale. So whatever gain was originally recognized is going to be eliminated. So in 2014, I need to reduce that amount. But because they inflated the amount of the value of the asset, the $40,000 is going to be the amount that's going to be depreciated. So that additional $10,000, that's the issue we're dealing with here. Well, we wrote up the value of the asset by $10,000. Again, that's going to be divided by 5 years, which means that you're going to take, if I leave everything the way it is, the subsidiary will take an additional $2,000 per year of depreciation. So when you consolidate, I have to eliminate the gain and eliminate the impact of that increased depreciation by adding it back, by making essentially a credit entry to my depreciation account. So that in 2014, my net effect here is a minus $8,000. Now, in subsequent years, like in 2015, the only thing I need to worry about is the $2,000. That, in a sense, that's going to reduce my depreciation expense. So the net of when I reduce the gain, okay, this is going to be a debit, this is going to be a credit entry, so that nets out to $8,000 in the first year. Then likewise in the second year, I'm only going to have to worry about the plus $2,000. Okay, that's going to be added back each year. Okay, the explanation for number 9 is a little bit more straightforward. The transfer price is $430,000, $430,400. The book value of the asset is the original cost of $460,000 minus the $92,000 of depreciation. That is, it's $460,000 is being amortized over 10 years, or depreciated over 10 years. That's minus 92, which gives you a book value of $368,000. So the unrealized gain here, because it's sold between assets, is $62,400. All right. The second part of the question is, what is the amount of excess depreciation? Now, originally, it was purchased for $460,000, and so it was being depreciated over 10 years, so they were whacking off $46,000 per year. Now, that would have been, over 10 years, that would take you down to a salvage value of 0. But because they sold it at an inflated amount, that is over and above its book value, the sub has brought it in at $430,400. But because 2 years have elapsed and there are only 8 years left, it's going to depreciate it over 8 years. So the $430,400 divided by 8 gives you the $53,800. So the excess depreciation here, which is going to have to be added back, which is going to be a credit entry, is going to be the adjustment. So in the first year, that is, you have to eliminate the gain. So you're going to make a debit entry, and then a credit entry to depreciation. So the net of these is the $54,600. Okay, that's going to be the reduction in terms of net income for the year because of the sale of this asset between these two different entities that are related. All right, number 10 is pretty straightforward. Add the two revenue accounts, subtract out the amount of intercompany sales. And again, what I always goof up on, and I always forget, is to eliminate any intercompany sales. That would be the reduction to get at the net amount of revenues between the two entities. All right, The adjustment for gross profit is twofold. Now, the three easy adjustments here are to take the sum of cost of goods sold, the parent plus the subsidiary, less the amount of intercompany sales, which they already told you up here was $100,000. So I had to eliminate the sales up here for number 10. Likewise, I have to eliminate the cost of goods sold for $100,000, the same amount. Okay, now the elimination because of intercompany inventory can be determined one of two ways. One is that they tell you that there's still $60,000 worth of inventory sitting on hand. You have $100,000 of sales. They say 60% of it has not been sold. So fine. And then likewise, they sold the inventory. It cost them $80,000. They sold it for $100,000. So the gross profit rate is 20%. So 20% of that $60,000 gives you $112,000. Another way of looking at it, which the book sometimes does, maybe is a little bit of a shortcut, is to say, okay, what's the total gross profit that was available? It was $20,000, okay? Well, if 60% of that is still remaining, then 60% of that gross profit has not been realized. So that will have to be added to cost of goods sold. Again, be careful of the plus and minus signs here. These are the sum of the two cost of goods sold figures. I eliminate intercompany sales. That means I'm going to reduce my cost of goods sold. But at least in the first year, I'm going to add or increase my cost of goods sold for the amount of gross profit that was not realized because the inventory was not sold to an outsider. All right, consolidated expenses are very similar. First, you have to get out a couple of adjustments that needed to be made here. Okay, it's actually pretty straightforward. These are the numbers they gave you in terms of the equipment was undervalued by $25,000, and the formulas were undervalued by $50,000, and the remaining life on these two different assets. So this gives you the amount of amortization that in essence will be added to the subsidiary's expenses, okay? So these are given to you. You really don't need to do much more than this part right here, just from the information. Now, if I take the two expense figures, 20 plus 10, in other words, they have 20,000, the parent, plus the 10,000, of the subs, and then add the 7,500, it gives me the $37,500 of expenses that would be consolidated expenses that would be recognized. All right. Well, the beginning amount that's attributable to non-controlling interest, number one, they simply tell you $65,000. Now, if you want to be a little bit more specific, you can say, well, fine, I could go back to the original book value of and take 20% of that. That would give me $50,000. The excess fair value that was attributable to the assets, $75,000 both to the formula and to the equipment. $75,000, well, 20% of that gives me $15,000. Again, this is a little bit more long, a little bit more theoretical way. This was given to you. Well, okay, now that's my beginning balance. Then I add to it whatever net income is earned by the subsidiary that's attributable to non-controlling interest. So the net income here is $110,000 less the amortization that I just calculated at number 12. That is for the equipment and the formula. So the 110 minus 7,500, take 20% of that gives me 20,500. Add a 65 plus that, I get the 85,500. That is the ending balance of non-controlling interest. That is the amount of income that would be attributable to non-controlling interest here is the 20,500 added to the beginning balance. That gives my ending balance. All right, equipment is pretty straightforward. Just the sum of the two. And then I have to make the adjustment because of the, I had to mark up with the purchase of the subsidiary. I was allowed to mark up the equipment to its fair market value. So that gives me the plus 25,000. And then at the end of the year, I have to recognize the amortization of that. So the net amount is really take the sum of the two plus 20,000 gives me the answer here of $760,000 for the equipment. Okay, so actually the inventory, we've already done part of it, and that is we've done this part right here, the adjustment because of the intercompany sales, the fact that there's $60,000 of inventory that hasn't been sold, and the 20% gross profit, or the total gross profit here is 20,000 times 60%. The adjustment here is 12,000. So the inventory is going to be written down by that amount. That is, I take out that gross profit. So I move from 260 down to 248. That gives me then the answer B. Right, I'm going to go ahead and post this to Moodle. The answers to the questions are already indicated up here. So I think those are pretty self-explanatory for number 2 and then 10 through 13. So take a look at those. I think I had you guys do number 2, then 10, 11, 12, and 13. So take a look at the answers to those. I think that the answers are a little bit long, but they're very thorough. And I would say that if you have any questions, give me a call or stop by, or we can talk about the answers to the questions. So if there's anything both in either the questions or the problems that you're not clear about, or if my explanation was not clear about, which is always a challenge with this, please stop by and I'll be glad to go over those with you. Thank you.